Well, hello again. This is Liz right here at ETBS, the tax advisor, accountant, and your QuickBook consultant. I'm going to start with part three. And this one we're going to cover in this, whether you're watching this in YouTube, it's the video, obviously. If not, you're probably listening to it in my other podcast channel that I have. But the business section, it's really important for all of you who do have not only an LLC or even a partnership or perhaps even an S corp, but even for the sole proprietorship. That's right. For anyone who has to file even a Schedule C, this does apply to you because remember, there's been big changes with what we call the entities and pass-through entities. So if you can listen to this, hopefully you might be able to learn something and it's going to help you file the tax return. Now remember that all this is going to be effective as of this new year of 2018. I'm recording all these videos, the series of videos, really on the very first week of January 2018. And this is going to be able, people who can listen to this video and podcast, they're going to be able to utilize this information for a long time. Because again, with individual taxation, everything is going to be what we call a temporary law into 2025. However, with the business, supposedly it is permanent. And I say supposedly because, well, there's always could be changes no matter what. And I emphasize that from the beginning of my video. So let's get started with the business section because there's a lot to be covered there. If you haven't seen video one, which we did I did the introduction for it, please go back and do that. Take the time to do that. Overall, I believe that the total of the three videos, it's maybe an hour max. I really believe it's worth your time, and hopefully you feel the same way. And again, feedbacks, comments, you're welcome. I'm learning as I'm going here and trying to share my, my information to help taxpayers like yourself, hopefully avoid some of the headaches that I see so common, especially when these big changes happen because even I, as a tax professional, means, I'm still going through the little loopholes and ins and outs of how everything is supposed to be working with the new regulations. So anyhow, so we're going to go for the next slide. And the ones that I'm just passing right now, we actually went through that on the individual tax law changes, and that was in video 1 and 2. So this one, we're going to start actually with the business. And let's get started with the corporate tax rate C corporation. Now, I want to go ahead and emphasize that C as a Charlie corporation, what we a lot of time call Inc. Okay, now, usually C corporations are, normally most of them are public companies, right? So any company that goes out to the stock market and sells stocks, obviously, they need to be a C corp. Okay. Second of all, that's because it allows foreign investors to be able to purchase those stocks and also make investments into the companies, whether they are partly active investors. And if that's the case, they can be foreigners. So this is a very old entity and legally. And it's what we call double taxation, meaning that you have the C corporation gets taxed through the income that you generate through the company, but you also get taxed with the distribution, or what we call the dividends, that you get from the company, and those are considered ordinary income, and therefore they are taxable income, meaning that you are you need to pay what we call the actual payroll tax, and that is applicable to Social Security, the Medicare, and so on, and obviously the federal, which is your tax bracket. So in the second part, C corporations have to pay through, like I said, that company, so it's a double taxation. So what happened? It was a little bit of not a very attractive entity, especially for domestic and citizen and residents from the U.S. because, again, with other entities and legal formations, as we call them, they had the option of being what's called a pass-through entity, which is the next paragraph that we're going to discuss in detail. But with the C corp, you could bring a lot of, like I said, foreign investors into your company, and they didn't require them to have, to be residents or to even have, Social Security, as long as they had a monetary investment in the company. They were able to do contributions, if that makes any sense. Now, the downside of the C Corp and why so many domestic business owners were avoided is because it was very high. The top corporate tax rate was currently at 35%. Now, that was one of the highest almost in the worldwide taxation in the entire globe. I think the one sliding underneath us is United Kingdom, and I think they're in about 34%. So this has been a big change, and I want to think that there are going to be a lot of U.S. C corporations that are perhaps going to start bringing business back to the United States, because one of the reasons they were trying, and not only tried, but they did for many years, use other entities from foreign countries because of reducing their taxation as they came into the U.S. So this 35% is no longer, it's history. I'm really, really excited about it. And again, I really have a good feel that it's going to really help a lot. So good news is that originally it was supposed to drop to 20%. It didn't happen based on, obviously, the deficit that we're going to have, because all these tax cuts, while it might help a lot of the taxpayers and business owners, there's always a positive and negative to everything that it's done when it comes to laws, when it comes to changes. And the downside of it is that it's going to obviously increase our deficit. And if I'm not mistaken, it's going to be like a $1.5 trillion, with the T. So that's the bad side of it. Hopefully, we're going to be able to make up enough to cover, the gap that we're going to have. But going back, the good news is that from 35, we're dropping to 21%. So we didn't get, a little extra percent there instead of 20, but it's okay. 21% is very good. I think this is going to be very attractive for the C Corps. Now, in my personal opinion, do I think, like some people are discussing, that hopefully this might also bring more job openings? Company is going to start hiring more people. They're going to start probably investing more money in giving advanced education to their employees, or perhaps extra benefits, whether it's going to be in, fringe benefits, like perhaps giving them, a greater, retirement account or contribution to it, or a better health insurance, or perhaps a longer vacation pay. No, I don't think so. That's just my opinion, and I'm very honest about it. I don't, because we have to realize that what's happening is that, if I'm a C corporation and I'm already making a certain amount of money, and now thankfully that Uncle Sam has decided to cut down, or as we call it, Mr. Trump has decided to cut down the taxes, guess what? That extra percentage that I'm going to save and not having to pay in taxes, then I'm just going to go ahead and reinvest it probably in the company. But it doesn't mean I'm going to hire more people, because I didn't generate that extra income because I, increase my sales. So if I don't increase my sales and I'm still making the same, there's no need for me to hire any additional staff. So that's my upfront and sincere opinion of what I think in some of these companies are going to be, thinking the same way and saying, well, this is great. We're going to save money because now we pay less taxes, but it doesn't mean we have to hire more people. It doesn't mean we're going to add more benefits to our employees. And it doesn't mean that we might even invest more in equipment. And by all means, I hope they do, because a great deduction is coming up with the equipment for companies. So that's another big plus for them. But the reality is, no, I don't think, bottom line, it's not going to improve. It's not going to help with employment. What I think might happen and so is that they're going to reinvest and probably buy back, their stocks. And obviously that will create, offer and demand. So, if they buy back more stocks, then their value of those stocks are going to increase. Because there's a shortage of stocks being available in the market. And obviously that's going to help the company. So either way, it's going to be a win-win situation, primarily not for employees, but it is to whoever is owner of the corporation or whoever is a investor, a shareholder, right? So if you buy stocks and you're for example, an IBM, stocks or Apple, then this is going to help them buy more stocks, and you're going to profit because hopefully you're going to get even a higher, dividend. Okay, so that's the positive side of it. Now let's move on with the actual. And before I skip to the pass-through entity, I put some examples. If you can look at here, so examples in countries like Russia, Turkey, Saudi Arabia, this corporate tax is only 20%. So these were countries that, we did think ahead of saying, well, if we have low enough corporate tax, that's going to help to keep business within the country. But again, like I said, there's other countries out there that they have very high taxation. Okay, so what the U.S. has done by lowering to 21%, again, I'm hoping it's going to improve the economy. Definitely it's going to improve, like I said, the investors and the owners of the companies. Not so sure, like I said, when it comes to the actual W-2 standard employee of, staff who's working for these type of C corporations. Now, what is a QBI? And, there's a lot of, I would say, confusion with that, because it's what's called qualified business income. Now, pass-through entities like a limited liability corporation, right, can be taxed as a sole proprietorship, meaning that you're almost like an independent contractor, right? You're doing your Schedule C. And then in your, obviously, tax with self-employment, okay, which is Social Security and Medicare. Now, on top of that, you also have what's called partnership, which is great, because if you have more than one single person in that LLC, that becomes a partnership taxation. And finally, you have a third option there, which is electing to become an S corp for tax purposes. That makes you also go through a pass-through entity. Okay, so that's the beauty of LLC. The nice thing about this is that there was a lot of people that were running the LLCs, and even though they were single, just one single person, like I said, they could be taxed as an S corp. And by doing that, it will just hit them when they will file the tax return. Yes, they will still file a business return, but on top of that, they will have to do their 1040, which is their personal. And then at that point, they will end up paying taxes, because remember, any income that the company, the LLC made, it passed through their 1040, meaning that they're responsible to pay for that tax, for that net income, or what we call net profits of the business. So if you had, $10,000 of, let's say, taxable income at the end of the year, and that was your profit after you deducted all your, expenses and everything else, and perhaps pay wages to other, employees, including yourself, because in S corp you have to be paying you, even though you're an owner, you need to pay yourself a payroll, a salary. Then in that case, you will have maybe let's say $10,000. So if you were in a 25% or a 35% or 33%, tax bracket, you will pay that percentage in taxation. Now that has completely dropped, especially for the ones who were 39.6, almost 40%. that has drastically dropped to 20%. That is incredible. I really think that part is going to help to hopefully, and I really, really mean this, to grow the small business, because the United States, it's really a country that it's not about the government employing the citizens or the residents. It's about small business entrepreneurs actually creating jobs for the people that live here. So we all pretty much the economy and increase of our prosperity in this country due to small business out there that we hire again within, even especially within this country. So they're going to have a great benefit. Dropping to 20%, I think is wonderful. Now, it's very important that you understand what a qualified business income is. And like I said, it falls into the partnership, the S corporation, which I'm right here going through my cursor. I know for some of you who are probably listening to this, you're not able to visualize, but the main point is that the deduction is 20% of qualified business income from a partnership, S corporation, or sole proprietorship. Again, let me repeat that, sole proprietorship. So if you do not have an entity and you do not have an LLC, but you are filing as a self-employed in a sole proprietorship, this will apply to you. That's right. It will apply to 20%. So even though you maybe before, until last year, you were in a 25 or in a higher bracket, now you're going to get the benefit of the drop, meaning that more money you get to keep in your pocket. Good news, right? That's always good news. So anyhow, QBI is the net amount of items of income, gain, deduction, and loss with respect to a trade or business. Again, do not misunderstand this. Got nothing to do if you're an employee and you're in a W-2. This does not apply to you. I want to be clear about this. It does not apply to you. Okay, you need to be self-employed or what we call a sole proprietorship in the Schedule C to deduct the trade of the business, not only the income, but also what is considered the deductions. Okay, now business must be conducted within the U.S. to qualify. That's something important. So let me give you an example. Let's say we have a lady by the name of Mary. Mary's a small business owner with a Schedule C, meaning that she is self-employed. Now, who makes about $100,000 from her business, okay? Now, Mary, her taxable income is $70,000. Why? Because she made a gross income, a total income in the year of 100 minus $30,000 that she's eligible to deduct, because maybe she had office supplies, she had to spend in rent, she had to have car expenses. So at 100, she had a total of 30,000 expenses in her business. That drops it to a net income of 70,000. Now, on top of that, that $70,000 under the new section 199A, as an example is called, the deduction is 20%. So 20% out of 70,000 is $14,000. Okay, so that's how the math works. It's very simple. So you're actually taxed on the 20%. Now, watch out with this, because people might think, well, that's wonderful. If I have a company and I'm making already, let's say, $250,000, or I'm making, $200,000, whatever, it's not going to apply for the entire amount of your income. So that's the next thing I want to discuss with, okay? Now, the next step here is what we call the specified service business eligibility for the 20% deduction. What does that mean? Again, just because you made $250,000 and you're single, for an example, doesn't mean you're going to be only taxed at 20%. All right. What's going to happen is that 20% is only going to be on your first $157,500. Let me repeat that. The 20% will only apply on the first 157,005. Everything else will go into the old bracket. Okay, in other words, you're going to be taxed at your level, depending where you're at. Okay, so the first 20% will only fall into that amount. Now, if you marry finally jointly, you get 315,000. Again, 315,000 you're entitled to use in the section, again, 199A. Even if the taxpayer business is a specified service business. Okay, so the threshold amount that you need to keep in mind is that if you're making a single sole proprietorship, you're making 200, only the first 157.5, and then for married filing jointly, it's only going to be the first $315,000 combined. Okay, and that would be with an annual adjusted for inflation. There is going to be an adjustment for that. For now, we're discussing the numbers for 2018. Now, what is called treatment investment income? This is really important because what's really considered, what's going to be treated as a 20%, it's going to be the monies that you produce through a business income. Okay, so qualified items do not include specified investment related to income, deductions, or loss. Specifically, qualified items of income gain deducted does not include. So the 20% is not going to be applied, for an example, to anything when it comes to determining net long-term capital gain or net long-term capital losses. Okay, meaning that there is still a separate capital gain percentage for taxation. Okay, depending if you have long-term capital gains, if you have short capital gains and losses, remember that still applies to ordinary income, meaning that you're still going to be taxed. Okay, at ordinary income, meaning that it is based on your 2018 tax table. So if you're right now in a 15%, in that 50% drop to 12%, okay, with the new table, then you are going to be taxed at that 12%, okay, for that short gain because it was less than 1 year. Now, if it was a long-term gain, remember it's more than 12 months, that the capital gain will apply. And it can jump all the way from 0% all the way up to 25%. So again, dividends income and payments in lieu of dividends are not included neither. Also, any interest income, so that means the 20% again does not apply to the long-term capital, okay, neither to dividends and neither to interest income that you might generate and earn as a passive income through a money market account or savings account. Again, the 20%, I repeat myself, it's only for when you generate what we call a business, okay? And we go back here, a qualified business income. It has to be an income generated by a business, okay? Not by the type of passive income, all right? So let's go for the next thing that I really want to specify here because not all industries are included. I will go ahead and mention the ones that are included in what they consider to be qualified. That way you can apply this 20%. So if you are in one of those industries, then you be covered, like I said, for the first amount that I mentioned earlier. Now, which are those industries? Okay. These are a trade-owned business involving the performance of service in the field of health, law, engineering, architect, accounting, actuary science, performing arts, consulting, athletics, financial services, brokerage service, including investing and investment management, trading and dealing in securities, partnership interests, or commodities. That is what's considered industry qualification. If you're in another industry that's not part of the ones that I just mentioned, the 20% does not apply to you. So if you need to repeat this, it might be important. You need to be aware whether your industry falls on that special QBI, income. Okay, now reasonable compensation and guarantee payments. This applies for the majority. Guarantee payments apply to partnership. Reasonable compensation applies to S corporations. Okay, so QBI does not include any amount paid by an S corporation that is treated as a reasonable compensation of the taxpayer. QBI does not include any guaranteed payment for service rendered to the trade or business. QBI does not include any amount incurred by a partnership to a partner who is acting other than his or her capacity as a partner for service. Important that you understand this part. This does not include, again, on the QBI 20%. Okay? Next step, we're going to do what we call expenditure of Section 179. I'm really happy about this because, there's been a lot of ups and downs with how you can write off, as we call it, an equipment or some sort of equipment or furniture. It could be also even property when it comes for business purpose. And right now, what I like about it is that the law allows full expensing of short-lived capital investments. Rather than requiring them to be depreciated over time, for example, for 5 years, which was the normal thing for, short span of, like furniture, for example, we were able to do depreciation on that in less than 5 years, okay? Some computers and printers and so on, there were a depreciation of 3 years. So now the phase has changed out by 20% points per year thereafter. What does that mean? The Section 179, that's what's called, a deduction cap doubles to $1 million. And it phases out after 2.5 million. Then now with Section 179, you can actually take a full depreciation for short-lived capital investment. So make sure to talk to your tax professional, your CPA, whoever is a professional when it comes to taxes is very important. And I have to bring this up because part of the reason I'm taking the time to do this videos is because I really want to help people out. And what I feel the most is that, unfortunately, we have a lot of those, tax shops, the little seasonal locations that you sometimes see inside Walmart, or you might see it in small stores, perhaps in some of those dollar stores. I tell my prospect clients, please be careful, because this is something that it's you need to make sure that they understand what they're doing. And unfortunately, a lot of these people, these type of preparers are not really qualified. They're not experienced. They're used to doing a very minimum SIPR return. And I would say, just be careful. Really be very careful. Remember that, as the old saying goes, you get what you pay for. So, I have a lot of complaints after tax season of prospect clients calling me and saying, oh boy, I went to this place and now they're closed. It's already past, April 15th, and now I cannot find anyone. They shut down, the location in the office. The numbers got disconnected. They don't respond to my emails. And these are very common things that happen. It's not uncommon. And I hear it a lot after tax season. So again, sometimes we spend a little more upfront, but it's worth it because you want to have a year-round person who's going to be there. And whether, you hire me or you hire anybody else, just be careful. That's my best advice I can give you right now. Because I've seen too many cases and people are very discontent. So again, if you're in the Section 179 and you want to take that full deduction with the short-lived capital investment, now that's possible. And like I said, you could do up to $1 million, which is phenomenal. I mean, imagine here you're purchasing a large equipment and now you can expense it out. It's just great. I mean, it's just fantastic. That's going to reduce obviously your taxation, and hopefully you have enough to reinvest into the company, right? So these are things that I think is important as a business owner, because you're entitled to this. Okay, so if you do have an S corporation, you have a partnership, your LLC, these are things that you're entitled to Section 179. Take advantage of it. There's a lot of generosity right now with our new President Trump, with all these big changes that he promised, and well, some he has delivered so far. And others, like I said, it can always change again. I mean, supposedly these business deductions are permanent. Okay, they're not like the individuals. The individuals, supposedly, they're going to expire in 2025. And again, like I said, to me, there's nothing permanent. There's nothing temporary. Things can change within, a short span of time. It could be within even a few months. But again, for now, that's what it is right now as I'm recording this video. And so again, I'm here for you. So just please be careful. And like I said, make the right choice of understanding who you want to hire, especially like I always bring up to attention to my prospect clients. We specialize in privately held companies. And one of the industries that we do a lot is real estate, e-commerce, a lot of Amazon and eBay sellers. We do consulting and coaches, for an example, medical and dental clinics. We do sports and gyms, and we do retailers, entertainment industry, and a lot of restaurants too. So that's our niche. That's what we specialize. It's sort of like I tell, my clients that know me so well is that, if you have a medical condition, you just don't go to a primary physician, right? You go to a specialist. And that's exactly what we do in our accounting firm, is that we specialize in these type of industries because it's what we're used to doing over and over. So we're familiar with the type of expenses and deductions that you're allowed to. And also for accounting purposes, we understand very well the type of categories that are common for your industry. So, why a tax advisor and planner versus to just a tax preparer? There's a big difference. We can help you improve your bottom line by reducing this tax burden and implementing strategies that will leave you with more cash flow to grow your business. That is the reality. The more we understand your business, the more we understand the industry, the better it is to the owner. They will benefit, okay? Our fees are transparent, they're reasonable, and with a great value added to every service that we provide with pride and dedication, because that's the truth. So call us and see if we're a good fit for each other. No obligation, just a simple, 15-minute chat on the phone. You can reach us at 954-788-2870, 954-788-2870, or just go online and schedule the initial complimentary consultation. And our website is www.etbsfl.com. Again, that's E for express, T for tax, B for bookkeeping, S for services, FL like Florida.com. And yes, we are born in the cloud, and we still operate since 2009. And we are located in USA, in the wonderful sunshine state of Florida. So once again, thank you for taking the time to listen or watch this video. Please share, please like and comment. Obviously, this helps us to create a better exposure, and I can continue investing my time in creating these kind of videos and bringing you as much valuable information as possible. I know that the internet right now is bombarded with, unfortunately, a lot of false information and really people who are not experts in the field. Okay, so again, be careful. Not everything that you hear it's a true fact. Try and get information from people who are experts in their field. And I always say this again: if you want a specialist and you have heart problems, you go to a cardiologist. All right, you don't go to your primary physician. So the same thing. Please, take the time, shop around, make the right choice, because this can hurt you. It's not the money it's going to cost you that you're going to pay to your tax preparer to file your return. Is the money is going to cost you, because he might make or she might make mistakes that you might end up paying more money or less money, and then you get hit with a penalty and interest, and now you're in trouble. So please avoid these kind of headaches. They can be avoidable. They really can be. So again, I'm here for you. So please contact me if you have any questions, and I'd be more than happy to help you. Thank you so much. Until my next video, have a wonderful, wonderful time, and I will see you for the next time, which I'm hoping, by the way, make any comments and feedbacks if you feel like there's something that you'd like me to discuss. By the way, for some of you haven't noticed, but I have been bringing some special guests and to my podcast. I've been trying to convert these audios also into videos. Listen to them, because some of you might be in certain industries, or you're planning to get in one of these kind of businesses, and this type of advice can really, really help you. I always believe that you invest into your business, and especially into your education, and it's just going to make you smarter to make better savvy decisions, and hopefully avoid some of the headaches that honestly it can be avoidable. I really think so. Thank you so much, and until next time, take care very much. Bye-bye. And this is Liz.